So yeah, can you keep going on? How often do target date funds tactically deviate from their glide path designs?
Yeah, so before I get too deep in this, I want to talk about the glide path design and what we can do and what we can't do. So, glide paths are something that we can observe from time to time. That's essentially what we do each quarter. We see the asset allocation, and we see it across different vintages within a TDF series. So, right, a TDF series will have a 2025, a 2030, a 2035, all the way out to 2070. And I think there might be a 2075 on the market now, but there aren't many of them. And so you can essentially piece together the glide path by seeing how that asset allocation changes at one point in time across the different vintages. Now, is that their intended glide path? Not necessarily. They oftentimes put a graph in their prospectus that comes out once a year that kind of shows here's our glide path. But they also say, we can deviate from that. And oftentimes that picture doesn't change much from year to year, even if their asset allocation did change from year to year. So what they're intending to do in their glide path is very different than what we can capture. What we
Hmm.
can capture is just how did the asset allocation change? And so when we look at how did the asset allocation change, and we can do that relative to kind of how we expected it to evolve along the glide path, we see that within from one quarter to the next, they're changing their glide paths by about 4%. Now,
Hmm.
what that means is say you just had a two asset portfolio, stocks and bonds, 50-50. That means by the end of the quarter, you've gone to 54-46. So that's a pretty big shift. And if you go out a year from that initial point where you measured it, now it's 9%.
Hmm.
So very big swings in the glide path, again, on average over either one quarter or over the course of a year.
How do you measure the intended glide path of a fund family?
So again, that's what's really hard to understand is what is the strategic glide path versus the tactical glide path, right? Or the strategic asset allocation versus tactical asset allocation. Strategic generally is thought of as these long-term shifts of, okay, we've done a bunch of research and we've decided that we do want to increase the overall equity exposure. This happened with Vanguard. I think it was back in 2016, but they made a big strategic shift and all of their glide paths kind of shifted up essentially versus tactical changes are, ooh, our capital market assumptions have changed for this year. We really think
Right.
US equity is going to outperform international equity. And so we're going to switch and up US by 5% and decrease international by 5%. That'd be more of a tactical change. And so the problem is, as researchers, we can't get in the TDF managers' heads, and they don't put out press releases that say exactly what they're thinking when they make these changes. So I think it's really important to note that we are not capturing the intent really at all.
Hmm.
It's just when they made changes, did those changes end up to be good moves or not? That's kind of the analysis that we can do.
Man, okay. So you're like estimating what their intended glide path was, but you don't actually know what it was, right?
Exactly.
And then you're measuring whether they deviated from what you are estimating their strategic asset allocation to be.
Right. And so it's a couple layers here. But the basic idea is that we know the glide path is downward sloping, right? We can see how it changes from 2025 to 2030.
Right.
And so as we go from 2025 to 2026, we can expect a little bit of that drift to be incorporated into their asset allocation over time, right? We expect equity to go down a bit, almost zero if it's a long out retirement vintage like 2060s. If it's 2025, we expect a more significant decrease in equity. And so then we can say, okay, we expected equity to go from 50 to 49%. What actually happened?
Hmm.
And that's really where this kind of next level of research goes, is to say, how much was that change? What direction was it? And did it actually lead to better returns or not?
Hmm.
What effect are increasingly active tactical glide path changes having on the target date fund returns?
So on average, not a good effect. These are not huge effects, right? In the last paper, we were talking about 1% per year. We find about a 10 basis point effect here. So on average, because they're changing their glide path, it's hurting returns by about 10 basis points. Again, not huge, but when you think about Vanguard, 10 basis points is about what their fee is. And if all of a sudden you're layering an extra cost on top of investors by essentially being active when you didn't have to be, right?
Right.
These managers could have essentially said, hey, here's our glide path. We're going to stick to it. And they would have done better. right? That's the overall industry picture. That's not true for every manager, right, at every point in time, but that's what we've seen on average over the last 20 years or so.
So are the managers, they're not saying that they're doing this, right? If I understand correctly, because you're estimating what the intended glide path was and then measuring deviations from that. But the managers aren't, like Fidelity is not coming out and saying we're overweight, whatever in our asset allocation this year.
Certainly not with the target date funds. I think again, you get some of this discussion when they talk about their capital market assumptions, and that's
Okay.
more, fund families overall putting these kind of assumptions out there, but you don't see it in a narrative from the target date fund managers. And so it is a question of, I mean, I still wonder exactly why they're doing this. And
Hmm.
some of the managers, you get a chance to talk to them, and they have convictions around those capital market assumptions, and they really believe that they know what they're doing and that this is going to better position their investors. I've never gotten a sense that anybody is trying to do this against their investors. Everybody's trying to help the investors and get them better returns and get them
Right.
successfully to retirement. So all the good intentions in the world are there. On average, the industry just doesn't seem to be delivering where they think they can.
Man, so why are they still doing it if it's leading to underperformance?
I think this comes back a little bit to we were talking about behavioral things earlier, right? We are people, right? And one of the biggest things we see is that the underperformance from being active tends to concentrate when people chase returns, right? So I see that equity is overperformed in the last quarter, and rather than rebalancing, right, back towards kind of my intended or my previous glide path at least, instead I end up chasing that and saying, okay, just again as an example to make things concrete, you're 50-50 to start the quarter, and equity outperforms bonds. So maybe you end up just because of returns at 52-48, right? The rebalancing would have you go back to 50-50 and maybe actually decrease equity slightly to follow that glide path. Instead, a lot of these fund companies are actually chasing and saying, well, let's go 54% equity next quarter. And, to an extent, there is a momentum effect, right? So they might be trying to pick that up, but they don't seem to be doing it successfully over time.
Not doing this. I think, like, I don't think people using target date funds realize that this is happening. Does that
No,
make
not at
sense?
all.
Yeah. Okay.
Whenever I present this paper, people are generally shocked that there's that much change in the glide path, because glide paths are thought of as very stable, right?
Right.
We're just basically giving you this asset allocation and making small tweaks per quarter. But, when you actually kind of go to implement these things, there are all sorts of money flowing in. There's all sorts of money flowing out, depending on which vintage you're in. And as a result, there's a lot of management that has to happen to keep that glide path kind of where you want it to be. And,
Wow.
returns are going to be different across asset classes. So you do have to think, how are we going to rebalance? And that's a very active choice in managing the fund. So with all that, I think it introduces scope to make these other changes as well.
So it's really hard to keep the human bias out of this systematic platform.
Yeah, especially when you're getting paid to manage the fund, and there's
Amazing.
pressure to come up with your best ideas and put them into the fund, even though those best ideas might be really hard. I mean, predicting macroeconomic trends is not easy, right? There's a ton of, I mean, active managers picking stocks is hard. I think it's generally accepted it's even harder to pick macro moves.
So how do you know you're not just observing incomplete rebalancing at your sampling intervals?
So again, we only observe quarterly, so we can't fully rule out rebalancing. This is the academic in me. However, what we can show is that, look at people making that move from 52 to from 50 to 52% because of returns.
Yeah.
We can ask, what percentage of the time do they actually continue on and chase the return versus rebalance it? 38% of the time, people are actually going to chase that return. About 24% of the time, they're in the middle, and the rest, they're actually going rebalancing the other direction. So essentially, we can show how often people are chasing returns, and we're pretty confident that most of it is not driven by kind of a lack of full rebalancing.
Hmm.
And you can actually see big patterns across different fund companies, right? Vanguard, they almost entirely rebalance every quarter. Companies like, I think American Funds is another that rebalances most of the time, whereas JP Morgan or Fidelity, they tend to be much more active and more likely to be in that return chasing category.
That's really interesting. It's really interesting that it shows up by fund grouping like that. So what's your big picture main conclusion on how these tactical glide path changes are affecting target date fund performance?
For right now, it's not good. It's that when fund managers are active, they are doing so to the detriment of investors, right? It would be better if the whole industry decided to just kind of set the glide path and implement it rather than making these tweaks. Now, does that mean they shouldn't have researchers working on this and trying to figure out better glide paths? No, but I think there should be some tempering of how aggressive they are in making these changes. Another stat that I find kind of crazy is that in any given quarter, 40% of TDFs either add or delete a fund holding, right? So they're taking a fund out and replacing it with something. Maybe it's large cap for another large cap, or it could be that large cap's switching out for, a bond fund. But the fact that they're switching out that frequently tells me, we should all just say, hey, it's okay to not do too much, right? Maybe it should just be a mantra in the industry for a little while. And hopefully investors will do a little bit better because of a lack of activity.
Wow. That's amazing. Okay, our final few questions for you. So based on all your research, what are your views on the state of target date funds?
So I want to start out by saying I am a big proponent of target date funds, right? When the QDI, when they became a QDIA in 2006, what they replaced were basically money market funds. So 20 years ago, investors, if they didn't pick any other asset allocation, would just have their money in cash, right? They would earn very little, no stock market exposure, not going to set you up for a very good retirement. So shifting to TDFs has been a massive positive improvement for investors. I think there are huge trends in the industry that are decreasing the costs, and there are more and more really great products out there for people to use. That all said, there's this huge dispersion, so there's still a lot we can do to make TDFs better. And that's what I view as kind of my role as an academic, is to help people understand, one, there is this dispersion, but two, there are ways to find out whether your fund is performing well or poorly, and then you can make a change based on that. So really, again, my co-author and I want to get our data out there. That way people can make better, more informed decisions. You guys mentioned that it's less of an issue in Canada, and I think similarly in Europe, but I talked to a provider earlier this week that's actually launching indexes in Europe for TDFs. So these are products that are coming out soon, and I think TDFs are going to start bleeding into other spaces as well, making them even more important for us to understand well, and hopefully to make people understand and see exactly what's going on in them.
I want to come back to something we talked about earlier, just about the differences in glide paths. So if someone goes to the website that you've created and finds a fund that's underperforming its asset allocation matched benchmark, if they go and ditch that fund for one that has performed better, but they end up with a more conservative overall portfolio, is that good or bad?
Good question. I'm not going to say it's necessarily good or bad. It depends on what market returns are over the next however many years, right?
Right.
I'd expect them to generally be positive. Markets go up over time for the most part. But I think my big question would be, are they going to know which one's going to be riskier or not? Right? I mean, and this is a weakness in the data that we have out there so far. Right now, we are benchmarking to that replicating fund without considering the total risk level. This is something we've realized, and so we're working on developing some new tools. They're really aimed more at plan sponsors and consultants in the industry, or people that are trying to provide advice on TDFs, to really give you a deep understanding of the asset allocation behind each TDF, how that's evolved, and essentially do risk-adjusted benchmarks in addition to the benchmarking that we've done and talked about today. So I think that's where we're going with the website. We're not there yet, but I think that would be my big thing, is say, hey, if you can isolate on risk level, so if you have the risk level you like, now pick the thing that's performing best within that risk level. And so I think that's a really good question from your perspective, to say, let's think about risk level first before we necessarily hone in on how operationally effective you are.
Yeah, that would be super valuable if you could hold the risk level constant, then you could find the most efficient fund at that asset allocation. Super interesting. Okay, so it's safe to say though, you still think target date funds are definitely a net benefit to investors because it's much better than sitting in cash.
Yep.
But some work to be done, potentially, including work to be done on the ability to analyze and compare funds, even beyond what you've done so far.
Exactly, because you do want to do that risk-based adjustment, so you know, and then you can start putting yourself into the right category. Right? I mean, there's a whole other question of, do you know how to put yourself into the right risk category of a TDF?
Yeah.
Right. And so, I mean, that's a big struggle with the industry. And I think, at the end of the day, that comes down to better education, which lots of people are pushing for in this space. So hopefully, this can become part of that education as well.
So I've got to ask, since you brought it up earlier, what are your views? You've done all this work on target date funds. You've been talking to plan sponsors. What are your views on the Scott Cederberg 100% equity life cycle portfolio research?
So I think it's phenomenal research that Scott's done. Scott and Mike and Aijan all together. Personally, I have moved more of my portfolio that direction. I think so in full disclosure, I am much more into the basically half and half US and international equity now. I used to have a bigger bond position. I've followed their advice. Part of the reason I've done that is I think I have the stomach to handle downturns. Yep. Because I think the biggest problem is the behavioral side. If you're going to be all equity invested and we have some big global event like the global financial crisis happen again, it's going to be okay if you can withstand it and you're not going to sell at the bottom. But time after time, studies have shown that people do, right? I feel that I'm in a very fortunate position. I'm tenured here at the University of Arizona. My income stream is pretty comfortable. I've amassed a decent amount of savings to where if it got cut in half, I'm not going to freak out, I think, right? Maybe I would, and maybe I'd regret everything I'm saying. But because of that, I think you can invest more aggressively. Now, is that better for everybody? I'm less convinced, and especially when people can pull the trigger themselves to take money out. Studies have shown that investors are less likely to take money out of a TDF to sell it and move to something else because they're in a TDF versus other assets. So that's good. People are doing this less. But would that effect go away if we kind of went to these all equity portfolios? So especially if there's a bunch of people that are having not the all equity portfolios, right? Because if you see, my buddy down the hall, his fund only went down 20% and mine went down 40%. Now you're going to have even more bad feelings around it. And so I think dealing with these behavioral concerns are paramount to figuring out how to get people better portfolios for the long run. Because I do believe if you can maintain it, I mean, the data shows over a huge sample of, places and time that works. Now, holding the portfolio is a whole nother thing, though.
Yeah. I think the behavioral thing is a big piece of that for sure. I've seen, you mentioned it, but I've seen literature from a couple of different record keepers, like from Fidelity and I think T. Rowe Price, showing the data that you mentioned, where they have the plan participants changing their asset allocations. Mm-hmm. The incidence of that happening is much higher for people who don't have 100% of their portfolio in a target date fund. And it's minimal, like almost zero. And we can put one of these charts in the video for people who have 100% of their savings in target date funds. So it is pretty interesting to see that. And I think it's a really interesting question to think about. Would that change if the target date funds were 100% equity portfolios instead of whatever their current allocation is?
Right. I mean, my gut would say no, because most people aren't thinking about this decision, right? They're getting into the default and they're sticking with it. They're not going to really question it. It's the people that are paying attention that then log in and see how they've done poorly and then decide to make a change, right? So it's one of those, if you could just commit to not looking at your account for a decade, you would probably be better off. And I think there actually might be scope for that in the future, of providers creating products that people just can't touch, right?
There's like a lockbox. Yeah.
Yeah, exactly. I mean, these happen in, private equity, and we're talking all about making private equity public now. Maybe we should be thinking about the features of private equity that we can just put on public equity to make it work better for the investors and prevent these behavioral mistakes that, happen time after time after time and are probably going to keep happening.
Maybe that would break the expected returns, though. Like, I think with one of the early criticisms of Scott's paper, and they took it out of their paper entirely, I think, was the equilibrium effect of, if everybody did this, then the result would not hold. And I think for the behavioral reasons that you outlined, that's probably not a risk. But if we created private equity like lockboxes where people could take public equity risk without feeling like they're actually taking it, That might
Right.
that might have more significant equilibrium consequences.
Well, it might get to the money doctors, right? In a sense that people can feel like they can take more risk if they know they're not going to hurt themselves on the back end. But yeah,
Isn't that interesting?
I think to your point, the equilibrium consequences, like, Scott's paper essentially goes to, would there be a bond market?
Right.
Right now, there's a huge bond market. I don't think it's going away tomorrow. So, yeah,
Wow. For the behavioral reasons, I don't think it's going away. Like I've asked a bunch of our portfolio managers at PWL just because they're familiar with Scott's research. They've listened to him on our podcast. They've heard me talk about his paper. I asked them recently, all of them, why are your clients not in 100% equity portfolios? Like, what that research says. And I got a bunch of really interesting answers, but a lot of them were focused on that behavioral component. Like, yeah, we know what the research says. The client knows what it says, but they still don't want to be in a really volatile portfolio, even if they understand that in the long run, bonds might have their own unique risks and maybe even be a little bit riskier. They still don't want to see that volatility in their account. It helps them sleep at night. So I think it's hard to make that go away.
right. Unless we don't look at it.
Unless we don't look at it. Yeah, that's true.